Welcome back to Switzer. Lance Ley is known as the king of charts, and he jumped on board the Chinese stock market surge 12 months ago, but he's been travelling the world over the past few months as the treasurer elite for the Entrepreneurs Organisation. So what are his charts now telling him about the stock markets and the likes of gold going forward? Lance joins me at the desk. Lance, great to see you.
Thanks, Peter. Great to be here.
Now, we always start your segment by looking at what you said last time you were on the show. So let's take it away.
It could really come back down and trade within that range. Now, S1 is 11.8% lower. It's 4,485. S2 is 3,674. Now, that's all the way 27% lower, which is quite a fair way. But as you can see, you know, to go up like this in a vertical sense is really not sustainable.
All right, Lance, let people know what you were talking about there.
Well, the Shanghai market really, in that last chart, had gone up really vertical. And, you know, to go up at that time was like 120% inside of 8 months.
So were you bailing out, Lance?
Well, you know, I think that's enough, isn't it?
Yeah, that's exactly right.
20% in 8 months.
Without a doubt. And it actually went, did it go a bit higher than that?
It did.
150 in the end, didn't it?
Well, 127% in 8 months. But from the time that I came on the show, I thought that, look, it was enough. That's what I said. It actually did around about another nearly 10% more, and then had a very large fall, which we'll see in the charts.
Okay, right. So let's go to what you're seeing now. Let's go back to Shanghai.
Right.
It's clearly important. Okay, so let's have a look at the Shanghai chart. And as we're waiting for it, Lance, what are we going to be seeing?
Well, okay, here you go. So on the 9th of June, that was when I came on the show last. At that time, you can see really that was the peak. And as we said in that little introductory bit, you know, enough is enough. And you can see there off it came. Where I have S1 and S2 was where I thought it would go and trade in that zone. And as you can see, pretty much right after I came onto the show last time, it fell, and it fell through the S1. It went through slightly S2 and basically traded within the range that I thought. S2 is just, you can see there, just above 3,500 and 4,000. And currently it sits at 3,097, and it has fallen through S2, and I think it really should stay within what I've called now R1 and R2 ranges. It's gone down very, very fast, and I can really see it going into a 30% trading range between R1 and R2.
And then, Lance, the big drops were linked to, apart from the fact there's a ridiculous rise in the first place, and momentum had to change. There also were some significant decisions like depreciations, some concerns about economic growth in China. All these things have conspired to bring the market down. But do you think R2 is going to be a support level as well?
Yeah, absolutely. Really, R2 is at 2,760. That's another 11% lower. But this market has shown itself to really, I suppose, be quite volatile, to say the least.
Very, we might say.
And so I've given myself a very broad 30% range within which I think it should trade or could trade.
Okay, it's quite staggering when you see whenever the Chinese government comes up with a decision, like, for example, last week it was the $11 billion railway project, bang, the market went up. So the more the Beijing throws at stimulation, the more likely this market will turn around. Not necessarily go back to where it was, but it will provide the supports that you're talking about, I presume.
And this is the reason why I think that I remain positive this market. They have a lot of ammunition, like you say, to throw at it. You remember the days, if I go back to this chart, on the far left, what it did was it actually traded for 36 months within a 29-point range up to July of 2014.
Yeah, that sideways movement there.
That sideways movement there, really, it goes all the way back for 3 years, which doesn't even sit on the chart that's showing there. So it actually did nothing. And you might recall for all those 3 years, there were several times when it would go near that B level, and that was the bad level, Peter.
Yeah, yeah.
And so what happened was, what this move is a bit of a compression, I suppose, of a period of built-up pressure that it explodes up in a 127% move, and it has to come off. And for this to come off, I think it's actually a good thing, Peter.
Let's go to the S&P 500, because that's going to be an important leader for our market over the next few months. What are you seeing there, Lance?
Well, last time I was on the show, we can see the J that's pointing up there, which was the June show. At the time, I said that it hadn't broken down yet, but I was expecting it to break down to S1 and S2. As you can see from the chart, it actually did that. It actually fell, broke through S2, and as you can see, bounced back up very nicely.
It's a strong bounce, isn't it, Lance?
It's been a strong bounce. I think that the first move is going to be a move back into that range of the S1 and S2, where I think we will see a little bit more sideways action. But unfortunately, in the medium term, in my medium term, it means between 3 to 6 months. I'm expecting it to soften a little bit more, Peter.
Well, it seems to me, Lance, if we get a Fed decision either in September or later in October, that S2 level will be retested again.
Right.
Yeah, whether it's only a short-term test, you suspect it will be tested.
I think that it will be tested, and I think there is a good chance, depending on how it trades at S2, I would not be surprised if it traded down to S3. Now, S3 is 11.5% lower. I'm not saying that it's going to go there tomorrow or anytime soon, right? But, you know, that you've seen it before, Peter, where I've put these markings on the chart because there's indications already that that is something to watch out for.
It seems to me what you're saying, Lance, is that if a worst-case curveball scenario comes along, S3 is a possibility. If the scenario is a lot better than the worst-case scenario, then it's more likely we'll trade between S1 and S2. And if for example, the US economy starts doing well, and China actually towards the end of the year starts coming up with some positive data, can you see a new channel being created going up?
I certainly can. I certainly can. And the thing I would say in response to what you've just said is that I haven't got a sign at the moment that says we're not going to go through S2. You know, that's why I've got S3 there.
That's why we see so much volatility in the market. Because like you, there are other people who say, I'm not seeing strong enough signs to be committed one way or the other.
And you know what? Whilst it might look very bad on the chart, if you say it's going to go S3 and it's another 11% down, if you look at where we came from, and we basically did 69% in 2 years, S3 really is taking it only down to about halfway.
Exactly.
And we can come off that level, do a nice retracement back up, and see how it goes from there if things don't throw, as you say, a curveball at us.
Yeah, it's interesting, Lance. I know when I've looked at the course of the ASX 200 over a 30-40 year pattern, you see big breakouts. But if you start from the starting point and go to where we are now, it's nearly a 45-degree line with some breakouts to the high side and breakouts to the bottom side. But you draw a line through it, it's about 45 degrees.
There's a midpoint.
Midpoint. Yep. Okay, let's go to the next one. Gold.
So, Peter,
this is not looking good for gold.
Not looking good at all. There's a couple of things why I brought this up. We're looking at, obviously, the converse to the strength in the US dollar, the gold price, right? So this actually shows the opposite of the strength in the US dollar, basically the fall in the gold price. It also shows us that inflation is not a concern, okay, in the US and probably globally. It's not such a big deal. And so then what happens is, one of the things that perhaps, everyone is looking at is, well, what's the Fed going to do? And this would suggest to me that the last piece of that fall perhaps is almost pricing in ahead of itself, some kind of a move, some kind of a increase in the interest rates already, the Fed rates already, and hence you've got the those extra little bits of the fall in the US.
So you think gold is probably stabilising these levels and probably up over time, but at this stage, you're seeing more falls on gold?
You know what, Peter? What you'll notice there in answer to that question is, see how the 200-day moving average now is pointing down?
Yeah. That's the yellow line for our viewers.
The yellow line.
Yeah.
The price action is quite comfortably almost below that, right? Yeah. And unfortunately, Peter, at the best case scenarios for this to simply go sideways, it's starting to level out a little bit, the yellow line.
Okay, now we're out of time, mate, so let's go to the Australian market.
Okay. So the Aussie. This has been a very hard one to pick. And as you can see on the chart there, we were in a channel, okay, and this chart goes back all the way to July. It travelled up very nicely, and then it broke down, did a double bottom, broke back up into the channel again, and then off we've come. Yeah. So last time I was on the show was back in June. I said at the time I thought that we were ahead of the market and that it was going to come off. Yeah. It did so, just a little bit more, but, well, it did so a lot more subsequently. Yeah. I think that we really have done enough now, Peter, in the Aussie market on the downside. Yeah. We've gone back to the July 2013 levels now in this market. And, you know, we've gone through an adjustment with the commodities story within the global space. Yeah. And I think we're, again, I'm going to say this time, 3 months on from my last interview here, we're ahead of the curve. I think we've done enough downside.
So 5,000 looks like the kind of the base that will bounce off and will be tested, but you're more likely to see us go up from here than down.
Well, so 5,007 is a level I have, which is a 1.7% away, and I actually have a range of 7% up, which is...
As always, great to see you. I should give you an entire show one of these days, but that's great, Lance. Good to see you, mate. And once again, I hope you're right. So that's Lance Slade, the king of charts from Accountancy Invest. Thanks for joining us tonight. See you tomorrow night.